Welcome to your introductory guide to investing, where we'll carefully demystify the often intimidating world of finance, breaking it down into simple, actionable insights especially designed for beginners who are just getting started. Picture this: your money working tirelessly for you, steadily growing and multiplying over time while you concentrate on your daily life, career, or family, or even while you sleep peacefully at night knowing your finances are on a positive path. Investing holds the remarkable potential to completely transform your financial future, methodically converting modest, consistent contributions into impressive, life-changing wealth through the power of compounding over months and years. Let's begin our exploration with stocks. When you purchase a stock, you are essentially acquiring a small but meaningful piece of ownership in that particular company, becoming a part owner alongside other shareholders. This ownership stake entitles you to a proportional claim on the company's assets and a share of its earnings. As the company expands, innovates, and becomes more profitable, the value of your investment naturally appreciates right along with it. Stocks come with several compelling advantages, most notably their high liquidity, which allows you to buy or sell shares quickly and efficiently on major exchanges whenever you choose. Additionally, many established stocks regularly pay dividends, providing shareholders with periodic cash payments directly from the company's ongoing profits, offering a reliable income stream alongside potential growth. Moreover, getting started with stock investing is accessible, as you can often begin with a relatively low initial capital outlay, sometimes as little as a few dollars through modern brokerage platforms. That said, stocks do carry notable risks, as their prices can be highly volatile, experiencing sharp and unpredictable fluctuations influenced by broader market conditions, economic shifts, or specific company performance issues. During turbulent market downturns, it's all too easy to make emotional decisions driven by fear or panic, which can result in significant losses, underscoring why maintaining a disciplined, long-term investment perspective is absolutely crucial. Moving on, let's explore bonds next. You can think of a bond as a straightforward loan that you personally extend to a government entity or a corporation in exchange for their promise of repayment. In return for lending your money, the bond issuer commits to making regular interest payments to you throughout the bond's predetermined term, providing a steady and predictable income. Then, once the bond reaches its maturity date at the end of that term, the issuer returns your full original principal investment amount back to you in full. Overall, bonds are generally viewed as less risky investments compared to stocks, delivering greater stability and more reliable, predictable income streams for investors seeking security. They serve as an excellent choice for capital preservation and generating consistent returns, particularly appealing to individuals who are approaching retirement or prefer lower volatility in their portfolios. On the downside, bonds usually provide lower potential returns than stocks over the long haul, and their market value can decrease when prevailing interest rates rise, affecting their attractiveness. Finally, let's discuss mutual funds. To make it relatable, imagine preparing a nutritious smoothie by blending together a variety of different fruits for balanced flavor and nutrition. A mutual fund operates in a very similar way. It collects money from numerous investors like yourself and uses that pooled capital to purchase a broad, diversified portfolio encompassing stocks, bonds, and various other securities. This built-in diversification effectively spreads out your investment risk, ensuring that you're not overly dependent on the performance of any single asset or sector, much like not putting all your eggs in one basket. Mutual funds are expertly managed by professional fund managers who actively research, analyze market trends, and make informed investment decisions on behalf of all the participating investors. However, one primary drawback of mutual funds lies in the various fees they charge, such as management and expense ratios, which can gradually erode your overall returns, especially compounding over many years. It's also worth noting that even with professional oversight, certain mutual funds may still underperform compared to the broader market benchmarks, like the S&P 500 index, year after year. Grasping these fundamental concepts of stocks, bonds, and mutual funds represents your essential first step in constructing a robust and sustainable financial future for yourself and your loved ones. Keep in mind that investing is very much a long-term journey requiring patience, And committing to continuous learning and adaptation will be the key to achieving lasting success. If you found this introductory guide helpful and informative, we invite you to subscribe to the TM Finance channel right now for even more practical insights, expert tips, and beginner-friendly investing advice.